Thanks for joining us here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker and Scott Kerschner, also retirement tax partners. Let me not neglect them. ARHQ.com is the website. 419-794-3030 is the phone number. Ray Dalio is the CEO of the investment firm Bridgewater. He was recently speaking with Yahoo Finance about our national debt. The interest is now $3 billion, with a B, dollars a day, which is why the Trump administration is so determined to get interest rates down.
Now, in the private markets, credit markets, we just talk about a death spiral. That part of the cycle when the debtor needs to borrow money in order to pay debt service, and it accelerates, and then everybody sees that and they don't want to hold the debt. That's where we're approaching. But there's also interest rates. The interest rate on the debt is very high. And so when you cut the supply, you improve the bond market. In other words, it performs better. You'll get a lower interest rate. And when you get a lower interest rate, that's good for markets, good for the stock market, good for the economy and so on, which brings in other taxes benefits.
You know, often here on the show and in the classes you guys do, you guys talk about threats and opportunities. And this certainly does seem like there are opportunities out there. But that means there are also threats. If the rates go down, it could hurt retirement savers. How are you guys going to help adjust for your clients if that happens?
Boy, Chris, that's great. I remember when back in 2014, when the Obamacare came out, and a lot of the advisors like myself, looked at the doom and gloom. Oh my gosh, they're going to eliminate all of us. And it was the ones that succeeded that saw an opportunity. And I remember back at the beginning of the prior administration's term, when the interest rates started to increase, a lot of people were talking about the higher interest rates and how it was going to affect the credit card and the debt, that you carried as an individual. And I remember mentioning that this is an opportunity for any people out there that have a qualified high deductible health plan. You actually have the ability to open up and create HSA accounts. HSA accounts, it's a health savings account. They're a great mechanism, a great tool to put money aside. And it is 100% tax deductible. So you put this money in, it lowers your reportable taxable income. And with the interest rates going up, this was a tremendous opportunity to invest in these HSAs, earn some money, build your HSA accounts, because you can use that for any health-approved benefit, a medically approved benefit. And you can even use that when you do, migrate over into Medicare. So I remember talking about moving a lot of money and putting money in, fully funding and investing into your HSA accounts. But Nolan, that's one aspect of it. But now that the rates may start to come down, that may not be the best investment now, because you're not going to be earning money on that money anymore.
Well, I think that's a big part of what retirees want to know for a cut in interest rates. And, when we take a look at it, personally, I think with the Trump administration's on the focus of lowering interest rates in light of this national debt crisis that we have, you're going to fall into either one of two camps, either somebody that's a saver or somebody that's a spender. So my son, as an example, he's looking to purchase maybe his first house, either get a house or a townhouse. In his case, he wants interest rates to be lower because the mortgage rates he would pay would be lower. He has some car loan, and the lower the rates, the better off he is. Hopefully he doesn't, but he might carry a little bit of credit card debt. I, on the other hand, I don't have a mortgage on my house. I have no car loan, and I pay off my credit cards every single month. I would rather have interest rates be higher, because by lowering interest rates, what it's going to do is it's going to hurt myself and our retirement savers with the impact that it has on where they get some of the fixed rates. There's a lot of people, though, that come in and then they're not taking advantage of where rates are. So the Federal Reserve and the administration has indicated their plan is to lower rates. Scott, there's people that come into the office, and I see all the time they have extremely large balances in checking and savings accounts.
Sure.
I had a gentleman that you were working with. You had come into our office. He's a small business owner. And like most small business owners, he had a large portion of money saved up as a backup to be able to run his business in case things happen. We looked at the interest of the large savings that he had, and I think he was getting paid 0.08% interest.
Sure.
But money markets accounts today, as of the date of this here, just heading into March of 2025, you can still have a money market rate that's as high as 4%, instantly being able to catapult where those rates are as well. This is an area, Scott, that I say people should not get lazy about. People should make sure that they're working to make every dollar work as hard as possible. There is a cost to liquidity. Just having that money set aside in your bank account, it might make you feel good, but there's a cost associated with having that much liquidity, especially if interest rates go down in the future.
So for somebody like that, you take a large sum of money that, and I know who you're talking about because he told me, he says, I have a lot of money sitting in this savings account, and I know I should be investing it differently. He just come right out and told me that. So no, let me ask this. So if you took a large sum of that money, moved it into an account of some sort that's going to earn 4 point whatever percent, at what point do you look at, okay, maybe I should pull back? Or do you really even need to pull back if it drops to zero?
Well, you got to really look again at the cost of liquidity. And now is the time you really want to take advantage of where these interest rates are at. I mean, they're close to the highest they've been, right? They've come down just a little bit, but they're really the highest they've been since my children have been born. So when interest rates go down, what's going to happen is you're going to have lower rates on new bonds that come out. You're going to have lower rates on CDs. You're going to have lower rates on fixed annuities. When you get lower rates and you're at retirement time and you're living off of that income, when rates go down, it could force you as a retiree to take on more risk than what you're comfortable with because you have to try to get maybe a higher yield on your bond. Well, if you're going to get a higher yield on your bond, what it means is you could be repositioning your bonds from higher credit quality bonds to lower credit quality bonds. They're referred to as maybe high yield or junk bonds, and those junk bonds have to pay out a higher yield because they don't have the same quality. So that could increase your risk because what happens if we go into a recession? You may think that, well, I better get back into the stock market because I have to have more growth to offset that. With the market at or close to record highs, you're going to be taking on more risk. So long term, it can hurt your ability to keep up with inflation and potentially higher taxes. A couple of things that you can do. We call it the independent income system. And what that is building out a laddered approach. Within a laddered approach, what we're going to do is we're going to look at taking and making sure you have enough money that's liquid available in emergency accounts. There was another couple that you had recently come in. He's getting ready to retire from our school system, had a big bucket of money that they were setting aside just as a rainy day fund. We can reposition a portion of that rainy day fund, and if they have an emergency, they have the ability where they can access that money anytime that they want, but shifting it from their almost zero interest bank savings to a high interest money market account immediately puts more money back into their pocket. The next thing that we could do is we can lock in rates anywhere from 1 to 3 years, and using FDIC insured CDs, if rates go down and they have that rate locked in, it can be a rate that's then protected for the next couple of years. And if they don't need it, maybe they're not going to buy a car for a couple of years, another great thing to do. With Insurance Companies of America, we can lock in interest rates for as long as 10 years. Some people just want to set it and forget it and lock in the higher interest that's available today. So a lot of great choices and options. But for retirees living off of their income, if you're within 5 years of retirement time or you're already in retirement time, with interest rates already happening and more coming, now is the time that you want to have us look at your fixed income part of your portfolio and maybe consider how do we lock in higher rates for a longer period of time and not get stuck with lower rates as if and when the Federal Reserve and the Trump administration gets the ability to try to lower interest rates. That can be done in putting together that independent portfolio analysis and looking at your situation. Just one of the things that we do in that retirement team action plan.
You can find out more about the Retirement Team Action Plan and the Independent Income System on the website, arhq.com. You can also set up a time to speak with them, start developing your own Retirement Team Action Plan as it pertains to you, because at the end of the day, what's more important than your personal circumstances. 419-794-3030 is the phone number. Again, the website arhq.com. Also check out the events tab over there. Find out more about the Economic Summit, all kinds of events they have going on. They'd love to have you out there. And if you can't make those, you want to sit down with them, you can reach out right there. And one more time, the number 419-794-3030. As always, we want to thank you for joining us here on America's Retirement Headquarters. It is the home of the Retirement Guys formula and America's Medicare Associates and Retirement Tax Partners. Hope you have a great day ahead of you. Thanks for taking the time. Gentlemen, appreciate the time as always. As we wrap up, I want to leave you with the final word.
Well, Scott, I just want to tell you and your family have a great time on vacation. I know you're going to get some warm weather here. For the rest of us here in Northwest Ohio, March is here. Warm weather is coming. And in the meantime, just remember, when you think retirement, think America's Retirement Headquarters. It's one location for your entire retirement. We'll be back next week, same time, here on Toledo's largest talk station, 1370 WSPD, and also available on all of your favorite podcasts that are available out there. Just type in America's Retirement Headquarters for more great information on how to retire.